Yo, good morning, everyone, and welcome to the morning market report, guys. We got a mixed market right now. Market's getting a little bit of a pullback, waiting for this Jerome Powell speech. He's getting ready to start talking here very soon. We're going to be live streaming it here today. Taking a look at the chart, guys, you can see we are getting a bounce right now off of this lower level of the Fibonacci's right behind my head there. Let's move it over there. Getting a little bounce right there. This was what I was talking about that I didn't want to see, though, is a lower low and then a lower high, and then a lower low, and then a rejection up to 887 and then down. But we found support on a double bottom here. We're going to see if this holds for us. We're going to be watching that chart while we're watching the speech today, guys. But yeah, we're going to jump in right now. You guys know what time it is. Take your seats, get your notebooks out. Class is in session. Let's go. Good morning, everyone, and thanks for joining us here on the Morning Market Report. Let's go ahead and bring up OC. I'm watching here closely to see if this is going to start off. We're live watching the setup right now on Jerome Powell speaking. But yeah, we've got a ton of people in here right now. I appreciate everyone that is in here with us. You guys are awesome. It looks like we have a lot of people over on X with us right now. OC, if you're watching that, do you see it on the live stream? It's like hitting 700. I don't know what's going on here, but we're just going to go with it. So yeah, I don't know what happened on X, but we got pushed out somewhere. So we'll let it ride. But let's go ahead and get into the chart, OC. Let's jump over into the chart. Let's talk about that. And then Jerome Powell getting ready to speak. It looks like the intraday right now in the stock market is getting a little pump up. So we're going to do a quick recap on what's going on with the markets, and then we'll get into everything going on with the speech, and we'll look at the chart. So looking at Bitcoin right now, guys, this is the levels I was talking about. And I brought this up on the Chart Hackers group. That we had to sell off, right? And we're looking at fibs here from a low to a high. So there's your low to the high up there, right? And we had this fib. I was watching. We kept getting rejection off of the quantum reactor, I should say. Came down, hit the dynamic reactor, came up, rejected off of the 50, downside move. Came to the 786, rejection off the golden pocket. Came down here, caught the 887, rejected off the 786. Came down to the 1-to-1, came up, rejected on this 887, and there was your entry for a double bottom long, right? Was actually setting up the show, so I missed that myself, but I put that out to everybody. Right now, I am watching for the 786, $114,600 might be a level that we get that rejection on. That's what's going on with Bitcoin right now. I will point out overnight, we did print a peak seeker and a 4-hour bullish divergence. Money flow, though, still sitting flat and in the negative. So keep an eye on that. I think that this could be a trap. Honestly, with Jerome Powell speaking, it's hard to say. Let's go jump over into the news, and we'll bring up Duo Cam here, News Cam with OC, and let's just talk about what's going on overall. A lot of a quick reaction here. So we're going to roll with it, guys. Looking at the crypto market cap right now, we're at $3.816 trillion, about 10% undervalued. Bitcoin sitting at a 53.8% risk level. And on that Bitcoin dominance without stable coins is sitting at 63%. With stable coins at 58.75. So, where is the speech at? I'm gonna go try to find and make sure that I'm not missing this speech, because I am not seeing it here. So give me 1 second to pull this over here while we're looking at this the stable coin Bitcoin dominance, but I'm not seeing Jerome Powell speaking there yet. Oh, it looks like he is speaking. All right, let's go jump over real fast, OC, and into that. I think that right now Jerome Powell is talking, so we're going to get that up here on the screen. Let's go to that, and then we'll go look at the chart here too. We're going to pull the Bitcoin chart up here, and we're going to put you onto this screen. So where's J Powell? Come here, J Powell, sir. Get up here on the screen, please. Come on up, J Powell. We appreciate you. There we go.
Needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution.
Yeah, that sounds slightly dovish there,
Moreover,
Eric Wallen,
tariff
for
rates
sure.
continue to evolve, potentially prolonging the adjustment process. It's also possible, however,
By
that
the way,
upward
this is a
pressure
5-minute
on
chart
prices
we're
from
watching,
tariffs
guys.
could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for
Coming
more than
up on
4
a value
years
area
and
low
remains
here,
a
I believe,
prominent
or
concern
value
for
area high.
households
What
and
is this?
businesses.
Value area low coming up right now
Measures
on
of
that chart.
longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term,
It is dovish.
risks to inflation are tilted to the upside.
He's being pretty
and
dovish.
risks to employment to the downside.
If you guys heard the grass trade, close it.
When our goals are in tension like this, our framework
Close the
calls for
grass
us
trade?
to balance both sides of our dual
Yes.
mandate.
Let's close
Our
the grass
policy rate
trade.
is now 100 basis points closer to neutral than it was a year ago. And the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks.
We have 35
may
viewers
warrant
on
adjusting
YouTube.
our policy stance.
We have over
Monetary policy is not
1,400 on
a
X.
preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance
SUI
of risks.
trade, we should
We
be
will
taking
never
50% out
deviate
now.
from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remained fully committed to fulfilling our
Man, we can
statutory mandate.
completely
and the
crush that
revisions to our
orb out of that
framework
orb this morning.
will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more
rejection
effective.
On that value area
The changes
low.
we made in this review are a natural progression, grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public.
If you guys are watching this on X, go ahead and come over here to the YouTube, man. We're over here. We're live. We're doing it. But if you're on X, I appreciate you being here too, man.
Fed listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis.
You got any trades going on some alts, OC?
Meetings.
Yes, I do have one on Bitcoin,
a key objective has been to make sure that our framework is suitable
let me get
across
this.
a broad range of economic conditions.
We're going to go over to your chart.
At the same time,
I can hear audio
from those of the great inflation and the great moderation, which in turn are different from the ones we face today.
Give me a second.
At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive
Guys,
to
if you are in
the
a TAO trade,
to me, the statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement
real fast on my chart.
Features that addressed
we got that rejection off of that value area low, came down, 786 bounce, it's going back up.
We emphasize the importance of longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation.
You got to speak up just a little bit. You said exit the XRP trade, you said?
Have evolved over the past 5 years.
If
During
you guys
this period,
take the
we
one
saw
quarter
that the
and one
inflation
quarter,
situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic.
Yes, JR. Take pictures. That's what it means.
Target,
take pictures
our
of your
policy
trades.
rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape.
What is this trade here, OC?
We noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions.
We hit an alert.
The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals.
Around there, I did not cut it exactly at that price action all the way up, and we have broken the trend line with strength going to meaningful highs in here to my left. So that's why we're taking profits, and then next TP is going to be at a dynamic reactor, and then we're going to left another 25% in of the full trade just to run out for a Hail Mary target.
About the inflation that arrived
Got it.
after we announced.
What's that level of the dynamic reactor for price take profit?
As I acknowledged publicly,
that is somewhere around 365.8.
Okay.
Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens.
Yeah, to note, guys, there was also an announcement today.
In economic downturns,
turn this down for a second.
Price stability.
There was an announcement that Trump is going to be speaking in the Oval Office today, right after this, too. That is going to be at Jerome Powell speaking at 10 a.m. Eastern Standard Time right now. And then 2 hours later, 12 p.m. Eastern Standard Time, Trump's set for a major Oval Office announcement. So keep that in mind.
This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs.
We have 1.7K watching this on X right now.
Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period.
Oh, we're pulling back.
Mainstream estimates of its.
He's talking about that nasty inflation. Now we're getting a pullback.
Persistently below our 2% target.
Just close the XRP
in the
trade
absence
already?
Of inflationary pressures, it might not be necessary to tighten policy based solely
closed
on
XRP
real-time estimates of the natural rate of unemployment.
No Piper for Fed, and you're not getting an emoji for Piper for Fed either. Username.
Shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the
death by AI voice. Wick's wife said. Sorry, 2Dub. Much love.
Opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent.
Bring that in on like a 15-minute candlestick, OC.
To wrap up,
we're getting some.
I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
All right. Well, there is
Jerome Powell
the speech.
His annual Jackson Hole remarks.
Let's go and let's talk about what we're seeing on these markets now, because we did get a little bit of a pump, but I think we're going to get a sell-off now, OC. Don't know what happened to me on your camera there, but hey, okay. It looks like I disappeared too. I ghosted you, OC. That's what I did. I ghosted you. Don't know where I went. I just said bye and left you. I don't know. Cool. Awesome. No camera for me. I don't need it. Let's jump over here, OC. Let's take a look at the chat. Shout out to everybody in the chat right now. If you're watching this on X, I appreciate you guys. We had over 1,800 people watching us on X. So shout out to everyone over there. But right here, my family, my alumni, they're here with me on YouTube. So shout out to WixY Fine 89, Average Crypto Joe in here, BC Port Corp. Appreciate that share out, and Alexandra G also on X. You guys are awesome. Crypto Squid joining us in here. XYZOZYX said double pump our bags. Nice. And also said you're going to abandon us for X. No, never. My alumni lives right here at the Piper Academy on YouTube. So OC, what are you seeing on the charts, man? Let's jump over. You didn't really have a chance to talk much. You were going through a couple of trades. What are you in right now? Let's jump over to your chart.
Perfect. Let's go take a look at what had happening here. I'm deciding to keep those couple of trades open. We called out XRP because it was the fastest growing one, and I want to secure that. We're out of this trade already. Yesterday on Piper Academy, right here on this channel, in the section Trading with OC night show, we were setting up for today's show, and we were looking for a couple of entries. Many of those, they actually played out, I mean, perfectly. Right there, perfectly. Look at that. It is truth, by the way, for the guys that are watching on X and that are not aware of what happened. It is true that we set up 2 possible entries and we divided a little bit of our money, thinking that today we're going to be having a lot of volatility. So that's why you see a quarter right here and another quarter. We measure our entries by holes. So one whole position needs a 3% of our wallet, and then we do half an entry. It is you get the point, right? So at this point, we're doing a quarter of an entry, 2/4 of an entry to complete one full entry, and we had a stopped out here as we coming back in. Let's go and check out Bitcoin because we have an upgoing trade in Bitcoin. And by the way, I forgot completely to look at it. And here you go. We have taken our first taking profits at this point. And I think I'm going to let it run for a little bit because despite we have the pullback here, let me go to the 4 hours. There we go. That makes a little bit more sense because we're getting to the resistance zone. Despite we're getting right here, I think that we're gonna consolidate and maybe make another push in the lower time frames. Like for example, here this 15 minutes. I did notice a little bit of a like a hawkish tone to it, but at the end of it all, I mean, it wasn't that bad because I think he ended up saying, well, that 2% ensures that what how he said it, that 2% that inflation stays in check or something like that, right? So I think at the end of it all, it was not that aggressive, and we are gonna be consolidating right here at the resistance. So coming back to Bitcoin, we have taken profits at 115. We also let's do the review that we have. ENA, we set up a possible trade in ENA. ENA did not take our trade, but we were looking for that area of exit right here. And then, the rest is history. So ENA, I was actually looking into ENA and LDO. LDO was almost there with the trade, never came back to recall that. Yesterday we were talking about this, and then we set up, you know what, it's gonna come back down, so let's just wait for it. And it never did. It never did. It actually took off right there. Too bad because we're looking for taking profits on LDO. That would have been a great and fantastic trade. But XRP played out fantastically. That trade is gone. We still have SUI. So we're going to be looking for our next taking profits around 365. TAO, again, we're going to be looking for some taking profits. And I'm going to be calling out SUI for a lower taking profits right there. And that is because we have our trend line in here. And we also have a classical resistance in there.
Nice.
And finally, yeah, thank you. Yeah, and finally, Bitcoin, we're gonna let it run. The only thing that we're gonna be doing with Bitcoin, it's moving our stop to entry. So right now, moving stop to entry, we have nothing else to lose. And something important that I want to mention: yesterday we set up a double entry. So let's go and check that out in here because that was kind of like a like made me mad, S's me off. So what happened here is that we were looking for this entry right there. All right. So I was expecting for a push up, maybe a retracement and low retracement, and then a breakthrough. But we also mentioned, hey, entering at a 1/4, the main entry, and then we're gonna be looking for a secondary entry if we get stopped out. All right. So right there, we got stopped out right here. So we re-enter with another quarter on the way up. So what happened? We still were coming back down, and then we did not hit the alert, but still I was looking at it because it hit my first alert. And then on the way up, we got it once again, and the rest is history. But in BTC, we got one stopped out, quarter of a position, and then another beautiful trade right there for another quarter of a position. So Bitcoin is already saved. We have taken 50% out of that trade, and we're expecting to have another 50% of the trade right here at 116,033 K. So those are the areas that I'm looking at. I'm gonna try to keep it throughout today, but if I see a 15-minute candle just retracing hard, I'm gonna be just closing everything up.
Okay, perfect. That's the trade to watch right now, I think, too. We could get a pullback of where we are right now. We got a lot of news coming in, OC. We got 51 people here watching this right now on YouTube. About 1,940 on X right now. It's crazy. But let's go get into this news. I want to talk about what we're seeing coming in. Jenny from the blockchain in the house. This is the place to be for macro financial happenings. Let's go. Appreciate you being here. Man, let's go talk about what's going on right now because we're getting a lot of data coming out. And this is a summary right now that we saw. Get out of here, sir. You go. There you go. This is the summary that's coming in from the Kabisi letter right now on the Fed Powell speech. So if you're just joining, Jerome Powell just got done speaking at the Jackson Hole guys. He pretty much dovish, in my opinion. That's what I saw there. But summary of the Fed Chair Powell speech, shifting balance of risk may warrant adjusting policy, meaning we may cut rates, right? Suggests downside risk to employment are rising. And we're going to look at something here in a minute. I was just looking at September 4th is our next big jobs report, guys. It's not looking good. So there we're seeing that, but we're seeing some projections that inflation might be coming in neutral. So that would give them cause for cutting rates in September. Labor supply is softened in line with demand. Fed is abandoning flexible average inflation targeting framework. So that flexible average is part of the methodology that the Federal Reserve was looking at for that 2%. And they're abandoning that. So that is why I honestly think number 4 is why we're seeing this market start to pump right now. Can't take stable inflation expectations for granted, though. So they're cautious, but they are making some changes to their setup there with that framework. So Powell says higher tariffs have begun to push up inflation in some categories of goods. Where are those goods at? Honestly, I'll tell you guys, it's metals. Metals is where we're seeing the inflations really start to hit the cost of goods and production. So we maintain our view that the Fed will point to the labor market in September. We are still calling for 25 basis point cut. That's according to Kabisi letter. Let's go take a look. Flashbang, guys. Sorry about that. We are now at a 91%. This thing has jumped almost 20% this morning on this talk of the from Jerome Powell over Jackson Hole. So 91.5% chance of a rate cut now. This was down to 70 this morning. But what I want to talk about here is on the economic calendar, and then we'll go look at this. What are the job numbers, right? What does that mean? Looking here at September 4th, we're going to be getting ADP. There it is. ADP employment changes coming out on Thursday morning, September 4th. We're at 104,000 right now currently. They're expected to be 65,000. So that's a major employment loss there. Of course, if we go down and look at what they're showing on the 5th, we're going to get non-farm payrolls and unemployment rate. Unemployment, they're expecting to be 4.2. I don't think that that's the case. I think we actually see this coming at 4.3 or maybe even higher. But non-farm payrolls is going to be dropping from 73 to 50. So we're seeing a lot more weakness in the labor market than we are on the effects so far of the inflation from the tariffs. So being that when you have inflation versus jobs, it is easier to fix jobs than it is inflation. But if inflation's not that bad and jobs are likely going to see that Fed cut happen as of right now. I do think that with September, we might get a 25 basis point rate cut. And the markets are pricing that in right now too, guys. Just take a look here at the TradFi side, looking at the stock markets. Dow Jones up 1.74% this morning. S&P is up 1.5%. NASDAQ is up 1.7%. Russell 2K small caps, they're getting bullish over there on the higher risk levels stuff, which is what we're seeing in crypto too, up 3.14%. Let's go take a look at the daily here on the crypto bubbles. Bitcoin moving up 1.6%. Ethereum's up 7.1%. XRP's up 3.3%. Solana's up 2.5%. Big movers on here are going to be, looks like that 3 to 4% range. HBAR's up 4.3%. It looks like Hyperliquid's up 4.3%. SUI is up 4.6%. Ethereum leading the way at 7.4% upside movement there. Let's go talk about this other piece that I wanted to talk about this morning. I didn't know if I'd have time. Told OC about it. But I want to see what this is showing here, because this is some interesting breakdown on jobs data. Yeah, there it is. Stock market news. So cracks are starting to show in the U.S. job market. And this is one of the reasons that I'm really leaning into the idea that we will see a rate cut in September. If you guys aren't tracking, this is a really good breakdown from stock market news about the labor market bend. It's bending here. Will it break? What does all these job numbers mean? Well, what are jobless claims? They're applications for unemployment benefits. If you get laid off, you file a claim. Every week, the government counts how many people file. That number equals the earliest red flag on the health of the labor market. And we've been seeing that those numbers have been pretty bad lately on the weekly. Every week it's coming out and it's ticking higher on the number of millions of people filing for unemployment. Last week, initial claims rose to 235,000 for 1 week. That's 11,000 up from the week prior. And economists expect 225,000. They missed their forecast by 10,000. Missing it by that much shows layoffs are much stronger than the models are predicting. Initial claims equals fresh layoffs on that weekly report that we give you guys every Thursday. So here's why direction matters. 235 isn't catastrophic. Breathe. But when the numbers rise week after week, it means layoffs are spreading, and it's not just a blip from one state or one company or one AI remodel or whatever. Not a natural disaster came in, and so unemployment ticked up in Florida, right? This is showing that there's a nationwide spread going on there with that. What about the 4-week moving average? It's just the average of the last 4 weeks of claims. And why does that matter? It smooths out the weird 1-week spikes that we get. And that average was up 226,250, the highest in a month. That's momentum, not noise. Now, the real red flag is continuing claims. And we talk about this. I have to go to the 1 star and go, all right, well, here's our continuing claims, guys. That's the real red flag that we're seeing right now. That's why I show this stuff to you all the time on here. This tracks people still receiving benefits because they haven't found a new job. It just jumped to 1.97 million people that are continuing to stay on. So that was the highest level since November 2021. Translation, rehiring is slowing down. Think of the difference this way. Initial claims equals I just lost my job. Continuing claims is I lost my job weeks ago and I still can't find a new one. When continuing claims climb, it means workers are stuck unemployed longer. And the insured unemployment rate did stay at 1.3%. What is that? It's the percentage of workers that are covered by unemployment insurance, AFLAC, right? All that good stuff, who are claiming benefits. It sounds tiny, but it's up from 1.2% a year ago, creeping up equals more people are relying on their safety net. So, we are seeing some weakness in the job market. State breakdown, biggest increases came from California, New York, Rhode Island, Michigan, and Maryland. What do all these states have in common? Biggest decreases were Iowa, Illinois, and New Jersey. Well, I guess two of those are, pretty left also. Anyway, why does Wall Street care so much about jobless claims? Because this data comes out every Thursday. And this is why we bring this up to you and show this to you on the show every week, guys. It's real time. Monthly job reports are lagged and revised. Claims equal one of the cleanest and earliest reads on labor stress. Don't get it twisted, though. They still come back and revise that shit all the time, too. So let's define some timing. Both are now rising together. The leading indicator and then the coincident indicator are moving at the same time there on job numbers. When claims rise above 300,000 and stay there, recessions often follow. We're at 235,000 now. Not recessionary, but it is rising, and that slope matters. And that slope, it's getting up. We're getting parabola on that on those job numbers, OC. There you go. A little parabola for you. This isn't happening in isolation. July's job reports already showed slower hiring and higher unemployment. When two data sets agree, it's rarely random, unless it's content creators all saying alt seasons here. Then that's random. No alt season yet, guys. For the Fed, this is a headache. If unemployment rises while inflation cools, they'll feel pressure to cut interest rates. And that, again, that's what we're seeing. Let's give this a refresh again. 91.5 is what it was at. 91.1. We are seeing a little bit of pullback there. Let's go check out the chart, see what's going on here with Bitcoin on the 3-minute, continuing up to the golden pocket. Let's put this on the 30 and just see how this is looking here. Yeah, I got that bounce on the 1-to-1 line. No lower low there, guys. We have broken out trend, and it now looks like we are moving into the golden pocket. There is a little volume here of data, and I'm going to pull over from here from the last time we were at this level, and let's get a fixed range volume profile across here, and let's see how this
really quickly. We just hit the 116.33. It's time to take another 50% out of the Bitcoin trade. And just calling that out because actually you got it right there. We're hitting the golden pocket, and golden pocket is a big resistance. So we better just start, packing our things. We're also at the top of, sorry about that. Let me go to the 4 hours really quickly so we can see it. Here you go. We are at the top of the range in here. All right. So hitting this top of the range and coming in clutch right here. There you go. You can see it 8:40. That is right now time for me, MST. We hitting our alert, taking another 50% out, and we have our stop to entry. So, by the way, guys, just a quick reminder, it's 50% of whatever you still have on the trade. Sorry for the interruption, Piper. Just wanted to make that TP call as we had it.
Awesome. No worries, man. We'll get you up here. There we go. Yeah, I'm watching that golden pocket right now, man. I think that's going to be a key level. That's coming in again, 116, 197 on my level here. Yeah, looks like a big recovery rally there, but don't get it twisted. We need to get through this golden pocket and that point of control. That point of control on that value area high, big volume nipple there, big old volume nipple right there coming in. That's that point of control on the fixed range volume profile going back into August, the beginning of August. So. That's going to be the level to watch right there. We'll go ahead and put that at 116,500-ish in the ballpark. So that's what I'm going to be keeping an eye on there for a resistance line. But I got to say, overall, man, looking at Ethereum, can you jump onto your chart and take a look at ETH? Because it said FOC is what it said. FOCG. I'm out of here. So let's go take a look at that on your chart.
Oh, yeah, absolutely. And hashtag Ethereum, hashtag F Ethereum. I was actually hunting it yesterday. So we had it right here, an entry right there on this one. And we called it out right here at 4,000. And well, we have just a little bit here, but I was expecting to have a re-enter in there on the same zone. It left out the ballpark. So far, we're getting into previous highs, and this is a little bit worrying for me, especially on the lower time frames. On the altcoins, we're flagging out, and we want to keep an eye on what's happening. Let me just clear this up. Perfect. And oh no, I need that for the night show because we're gonna be keeping track of that. Because in the night show we gave the entries. All right, so right here, this was our target at this area, and it's pushing hard. Something that I was mentioning, we're getting to areas of resistance on previous resistance, and we can see it right here on our classic support and resistance. Shout out to Chart Prime, always very accurate with that zone. Something important that is going on that we're going through, it is our VRVP. Let me hide all of my spaghetti so we can see clearly through it. And not only we have hit our predictive range, we have created a new set of predictive ranges. And guess where our blue line comes in? Right here at 4,687. So if you guys are not aware, when we create a new set of predictive ranges, the most recent pattern, or what happens the most, it is that we're going to find the next blue line. And the next blue line, it is right now, right here, around 4,687, 86. And that is also where we have our next spike of volume. So, yep, I mean, we're taking this volume and we're able to hit this off. I think I'm going to be opening a short on Ethereum. Talking about shorts really quickly. Let me see if I can have it here. So, ADA. All right, on ADA, let's go to the 4 hours. Oh, yeah, I see why I don't see it. ADA, we have an open position for a short at this point. So what I'm going to be doing right now, it's moving my stop to entry. And why do we have a stop, a short position? That is because we're hitting a trend line in here. All right, comes a little bit higher. A trend line in here that we were looking into, and well, then we were looking for that breakout retest. That retest is playing out right now. We were looking at it on the 4 hours. And well, then despite we did not took the long that we actually marked in here, well, that was fine. We are right now on a short. Important. If you took this short, move your stop to entry because I think we are in risk of getting stopped out. So if we're gonna get stopped out, let's not lose a single cent in here. So move your stop to entry, and then we'll see if we can retrace a little bit more. But yeah, that's what I got on Ethereum, and also wanted to give the update on ADA.
Awesome. Appreciate it, man. Yeah, guys. So keep an eye on the markets. It does look like we are doing a little bit of a pump up here today, but don't get too comfortable because we're still seeing weakening of the labor market, right? And that does mean a rate cut, but rate cut does not always mean markets go, boom, right? So when you get those rate cuts, sometimes it's a little too late. We're seeing that happening in the labor markets. Again, we're at 235,000 on that job unemployment filings, and so if we see that start to creep up higher, closer to that 300,000, that could mean some economic instability, so which will sell off the markets also. But right now, we ride the waves, and we do our DCA on a weekly. I was able to buy in down at that very low $112,000 level for the DCA Piper plan, and all of that is in our Discord. So that is about it for today, guys. Hope you guys enjoyed the show. If you guys are watching us on X, I appreciate everyone that rallied over here. Make sure you follow me on X, and also come over to the Piper Academy on YouTube and check it out. We're live every Monday through Friday, 10 a.m. Eastern Standard Time. OC, appreciate you, brother, always. It's great to have you as my co-host here every morning and hang out with those who drinking coffee and going through the markets. If you guys haven't done so, smash up the like. It helps us out immensely. And we will catch you guys Monday morning, 10 a.m. Eastern Standard Time. Until then, trade safe, use some risk management, and take care of yourself this weekend, guys. Spend some time with family. It's Friday, right? Peace, love, and profits. We're out of here.
That's the rap. Chart stack data never lie. Piper led the mission, OC in the sky. Spaghetti on the screen, but the vision stay prime. Chart prime visual signals on time. Alumni strong, we built from the grind. Lessons in the market that'll outlive time. Knowledge is profit, you know how we run. Till the next one, stay sharp, get it done. We'll see you at the next one.
What the fuck they're doing?
Morning market report out. Boom shakalaka. We'll see you at the next one. Morning market report out. We'll see you at the next one. Morning market report. Ow.
That was awesome, dude. Hey, it didn't break. What else you got?
Break.
Later.